Something important has shifted in the commodities market, and it didn't start with copper, but copper is now reacting to it in a way that demands attention. Over the past several weeks, copper prices have surged into territory that, until recently, most market participants considered extreme. On the London Metal Exchange, prices pushed above $13,000 per metric ton and briefly traded north of $14,000, setting fresh all-time highs. That move alone would be notable. But what matters more is how quickly it happened, who participated, and what it says about how capital is being repositioned across the macro landscape. This rally did not emerge in isolation. It followed a historic run in gold, where prices climbed relentlessly on the back of central bank accumulation, geopolitical stress, and a growing lack of confidence in fiscal discipline across developed economies. Silver followed with its own surge, fueled by both monetary and industrial demand. Only after those moves became crowded did copper begin to accelerate, and that sequencing is not random. It reflects a familiar pattern in late-cycle commodity rotations where capital first seeks safety, then scarcity, and finally leverage to growth. What this suggests is that copper is no longer being viewed purely as an industrial input. It is increasingly being treated as a strategic asset tied to long-term structural change. That shift in perception helps explain why the price response has been so forceful and also why the risks are rising alongside the opportunity. From a market structure standpoint, copper entered this year with relatively tight visible inventories, particularly in exchange-registered stocks. LME warehouse levels were already trending lower, and the decline accelerated as prices rose. That is a critical detail because it tells us this rally was not driven solely by paper speculation at the outset. Physical tightness existed before momentum traders arrived. However, once prices began breaking through prior resistance levels around $10,000 and then $11,000 per ton, the character of the move changed. Volatility expanded sharply. Daily ranges widened. Open interest increased. Momentum-based funds, commodity trading advisors, and macro hedge funds began adding exposure, not because they suddenly discovered copper's role in electrification, but because the price action itself validated the trade. This is where near-term risk enters the picture. When positioning shifts quickly from fundamentally driven accumulation to momentum-driven participation, price can move far beyond what the immediate physical market can justify. At the same time, there are real structural forces underneath this move that cannot be dismissed. Copper sits at the center of multiple long-duration demand curves that are still in their early stages. Electrification is the most obvious. Electric vehicles require significantly more copper than internal combustion engines, not just in the drivetrain, but across charging infrastructure. Renewable energy systems are copper-intensive by design, particularly wind and solar, which require extensive wiring and grid connectivity. Power grids themselves are being expanded and upgraded globally, especially in emerging markets and in developed economies attempting to accommodate both decarbonization and rising load from data centers. That last point is increasingly important. Artificial intelligence infrastructure is not software in the abstract. It is physical. Data centers consume vast amounts of electricity, and that electricity has to be generated, transmitted, and stabilized. Each of those steps requires copper. What the market may be underestimating is not just the growth rate of AI, but the rigidity of its material inputs. You cannot substitute code for copper when building transmission lines. This is why longer-term supply forecasts are drawing attention. Analysts are projecting a modest deficit in the near term, on the order of 100 to 200,000 tons annually, but those estimates expand dramatically when extended into the next decade. Some projections suggest cumulative shortfalls reaching into the millions of tons by the 2030s, assuming current investment trends persist. The key phrase there is assuming current investment trends persist, because mining supply does not respond quickly to price. Copper mines take years, often decades, to permit, finance, and build. Grades at existing mines are declining, not improving. Political risk has increased in several major producing regions, raising the effective cost of new supply. Even when prices rise sharply, the response is slow. That structural inertia is one reason copper behaves differently from many other commodities. It is also why long-term holders see pullbacks as opportunities rather than threats. But markets do not move in straight lines, and copper is no exception. The same characteristics that support a long-term bullish case also amplify short-term downside risk. Copper is economically sensitive. It responds to growth expectations, particularly in China, which still accounts for roughly 60% of global demand. Any sign of slowing industrial activity, tightening credit conditions, or weaker construction data can change sentiment quickly. We are already seeing hints of that tension. While prices reached record highs, several banks raised average price forecasts for 2026 to around $11,000 per ton, well below recent spot levels. That divergence matters. It reflects the view that current prices embed a degree of optimism that may be difficult to sustain without continuous positive surprises on demand or supply disruption. In other words, the forward curve is signaling caution, even as spot prices celebrate scarcity. This raises the possibility that the market is front-loading future deficits into present prices. When that happens, corrections do not require a collapse in fundamentals. They only require expectations to stop improving. If economic data softens, or if Chinese demand fails to re-accelerate meaningfully, copper could retrace a substantial portion of its recent gains without invalidating the long-term thesis. Technically, the market is stretched. Momentum indicators reached levels historically associated with exhaustion. Liquidity pockets below recent breakout zones remain untested. If prices fail to hold above the $13,000 area, the risk shifts toward a deeper consolidation, potentially back toward levels where the rally first accelerated. Such a move would likely be violent, driven by margin calls and forced liquidation among leveraged participants rather than a change in physical consumption. Margin dynamics deserve attention here. As prices rise, exchanges often raise margin requirements to manage risk. That has the effect of flushing out weaker hands. If margin hikes coincide with a loss of upside momentum, selling pressure can cascade quickly. This is not hypothetical. Copper has experienced similar episodes in past cycles, where structural tightness coexisted with sharp, sudden drawdowns. Regional pricing also adds nuance. Asian premiums have not risen uniformly with Western benchmarks, suggesting that some of the tightness is localized rather than global. That does not negate the bullish story, but it does argue against complacency. Physical markets tend to whisper before futures markets shout, and right now the message is mixed. At this stage, copper sits at an inflection point. Long-term forces are supportive, arguably more so than at any time in recent decades. Near-term conditions, however, are increasingly fragile. The market is being asked to decide whether this move represents a sustainable repricing of copper's role in the global economy or a speculative overshoot that needs to reset before continuing. That decision will not be made by headlines alone. It will be made through price behavior, inventory trends, policy signals, and the interaction between physical demand and financial positioning. And that is where the next phase begins. As the market moves into that next phase, policy becomes impossible to ignore, not because copper is directly influenced by interest rates in the way gold is, but because liquidity still sets the rhythm for all risk assets. Over the past year, global monetary conditions have shifted unevenly. Some central banks are cautiously easing, others remain constrained by inflation persistence, and fiscal policy has quietly taken on a larger role in driving demand through infrastructure spending, defense budgets, and industrial subsidies. Copper sits downstream from all of it. What's notable is that this rally is occurring without a synchronized global growth surge. Manufacturing data remains mixed. China's recovery has been uneven, marked by targeted stimulus rather than a broad-based credit expansion. Europe continues to struggle with energy costs and sluggish output. In the United States, growth has slowed from prior peaks, even as government spending remains elevated. That backdrop makes copper's strength more striking, but it also sharpens the risk profile. When prices rise faster than growth, expectations are doing more work than activity. This is where the distinction between paper and physical markets becomes critical. Futures prices can move rapidly as capital reallocates, but physical flows change more slowly. Smelters, fabricators, and end users hedge and procure based on operational timelines, not weekly charts. If prices rise too far, too fast, behavior changes. Buyers delay purchases. Substitution becomes economically viable. Aluminum, while not a perfect replacement, begins to look more attractive in certain applications. Efficiency gains are accelerated. None of these responses destroy demand, but they smooth it. Meanwhile, on the investment side, copper exposure has broadened. Equity markets have responded with strong moves in major producers. Companies like Freeport-McMoRan, BHP, Rio Tinto, and Southern Copper have seen capital flow back into the sector, not just from commodity specialists, but from generalist investors seeking exposure to the energy transition narrative. That matters because equity inflows tend to be more sentiment-driven and less tolerant of drawdowns than physical ownership. If copper prices stall or reverse, mining equities often react more sharply. Physically backed vehicles and commodity-linked ETFs have also seen increased interest, but they remain smaller relative to gold. That difference is important. Gold's investment market is deep, liquid, and well-established. Copper's is not. That means price discovery is still dominated by futures markets, where leverage is higher and time horizons are shorter. It also means that sudden shifts in positioning can have outsized effects. One thing the market may be overlooking is how sensitive copper is to marginal changes in liquidity. Even modest tightening in financial conditions can reduce speculative participation. We've already seen episodes where copper prices pulled back sharply from intraday highs as the dollar strengthened or risk appetite wavered. These moves did not reflect changes in long-term supply and demand. They reflected the reality that copper is still, at least in part, a risk asset. At the same time, the physical story continues to tighten beneath the surface. Mine disruptions, labor disputes, and declining ore grades are not headline-grabbing events, but they accumulate. New projects face permitting delays and rising costs. Environmental and social constraints are not easing. Even with higher prices, capital discipline remains a theme among producers, many of whom remember the consequences of overexpansion in prior cycles. That restraint supports the long-term case, but it does not eliminate cyclical volatility. China remains the wild card. Its demand profile is evolving. Traditional property-driven consumption has slowed, but grid investment, electric vehicles, and manufacturing tied to exports and technology are offsetting some of that weakness. The composition of demand matters as much as the level. Infrastructure and electrification tend to be copper-intensive, but they are also policy-dependent. Any shift in Beijing's priorities can ripple through the market quickly. This creates a layered outlook. In the short term, copper is vulnerable to consolidation or correction simply because of how far and how fast it has moved. The rally has pulled future optimism into present prices. If growth data disappoints, if inventories stabilize, or if speculative positioning becomes too one-sided, downside pressure could emerge rapidly. That would not be unusual. In fact, it would be consistent with copper's historical behavior during major bull markets. Over a longer horizon, however, the picture looks different. Structural demand does not need to accelerate dramatically to strain supply. It only needs to persist. Electrification, grid expansion, and data center build-out are not fads. They are capital-intensive processes that unfold over years. Even conservative scenarios suggest demand growth that outpaces supply additions unless investment increases substantially and consistently. The tension, then, is between timing and direction. Directional arguments favor higher prices over the long run, but timing arguments caution against extrapolating recent momentum indefinitely. Markets rarely reward impatience. They test conviction through volatility. As prices fluctuate, watch the behavior around key levels rather than the levels themselves. Does selling pressure intensify on pullbacks, or does it get absorbed quickly? Do inventories continue to draw down, or do they stabilize as prices cool demand? Do miners hedge aggressively into strength, or do they remain exposed? These signals will matter more than any single forecast. Copper is not gold. It will not behave like gold. It will not provide the same kind of psychological refuge during financial stress, but it may offer something different: exposure to the physical backbone of the next phase of global development. That exposure comes with cycles, drawdowns, and uncertainty. It rewards patience more than precision. As the market looks ahead, the question is not whether copper is important. That debate is largely settled. The question is whether current prices fairly reflect both the promise and the risk embedded in that importance. The answer is not yet clear, and the market knows it. That uncertainty is what keeps volatility elevated and attention focused. And it sets the stage for what comes next, as copper approaches a moment where conviction will be tested not by narratives, but by behavior. If you'd like, I can continue with part 3, carrying this forward into scenario analysis, what different outcomes might look like, and what signals are most likely to precede the market's next decisive move. As the market approaches that decision point, it's worth stepping back and looking at how copper bull markets typically resolve themselves, not in terms of final outcomes, but in terms of process. They rarely end because the long-term story collapses. More often, they pause or reverse because expectations outrun reality, leverage builds too quickly, or macro conditions temporarily move against them. Understanding that distinction helps frame what matters most from here. One scenario is straightforward consolidation. Prices remain elevated but stop advancing, moving sideways as the market digests gains. Volatility compresses, speculative positioning lightens, and physical demand gradually adjusts to the new price level. This would likely frustrate both late bulls and aggressive bears, but it would be constructive in the context of a longer-term uptrend. Time, rather than price, would do the work of rebalancing expectations. Another scenario involves a sharper correction. If growth data weakens, particularly out of China, or if financial conditions tighten unexpectedly, copper could retrace a meaningful portion of its recent move. That process would almost certainly be disorderly. Leveraged positions would be forced out. Mining equities would underperform the metal. Sentiment would flip quickly from enthusiasm to skepticism. Yet even in that case, the structural backdrop would not necessarily change. Corrections can strengthen long-term trends by removing excess and resetting positioning. A more bullish outcome is also possible, though it carries its own risks. If inventories continue to fall, supply disruptions escalate, or policy support accelerates infrastructure spending, prices could remain elevated or push higher despite already rich levels. In that environment, copper would increasingly trade as a scarcity asset rather than a cyclical one. The danger there is not the direction, but the fragility. The higher prices climb without rest, the more sensitive the market becomes to any negative surprise. Across all of these possibilities, one common thread stands out. Copper is being repriced in the context of a world that is more constrained, more energy intensive, and more capital hungry than it was a decade ago. That repricing process will not be smooth. It will involve overshoots and setbacks, enthusiasm and doubt. Markets are not designed to move cleanly from old equilibria to new ones. For investors and traders, time horizon matters more than conviction. Short-term participants must respect volatility, liquidity, and positioning. Long-term holders must be prepared for drawdowns that feel inconsistent with the narrative but are entirely consistent with history. Confusing those horizons is where most mistakes occur. What to watch from here is not a single data point, but a cluster of signals. Inventory trends across exchanges and in key consuming regions. The behavior of prices around recent breakout zones, changes in margin requirements and open interest, the tone of policy messaging around infrastructure and industrial support, and, importantly, whether physical users begin to push back more aggressively against high prices. Copper is not declaring victory here. It is asking a question. Can the market absorb a higher price regime without breaking demand? And can supply respond meaningfully within a reasonable time frame? The answer will emerge gradually, through action rather than commentary. Until then, uncertainty remains elevated, and that is not a flaw in the market. It is the mechanism through which price discovers value. Copper has forced itself into the center of the macro conversation, not as a substitute for gold, but as a complement that reflects a different kind of risk and a different kind of future. The next move, whenever it comes, will not just be about copper. It will say something about growth, policy, and how markets are choosing to price the world that's being built.